Real estate sector risk overview. The real estate sector remains one of the most attractive channels for money laundering because it allows criminals to place, layer, and integrate large amounts of illicit funds through seemingly legitimate transactions. Property purchases can conceal criminal proceeds while simultaneously generating investment returns and creating a veneer of legitimacy. Criminal organizations, corrupt officials, fraudsters, and terrorist financiers often use residential, commercial, or luxury real estate to store wealth and obscure beneficial ownership. The CAMS framework emphasizes that real estate professionals, financial institutions, and regulators must adopt a risk-based approach focused on transparency, source of funds verification, beneficial ownership identification, and transaction monitoring to mitigate financial crime risks. Real estate red flags. Several red flags may indicate money laundering or terrorist financing in real estate transactions. These include purchases that are inconsistent with a buyer's known income or occupation, all-cash transactions involving high-value properties, rapid property resales without legitimate economic justification, and use of complex ownership structures involving trusts, shell companies, or nominees. Additional warning signs include reluctance to disclose beneficial ownership, unexplained third-party funding, overvaluation or undervaluation of properties, transactions involving high-risk jurisdictions, and unusual mortgage repayment patterns. Frequent transfers of ownership among related parties may also suggest layering activities intended to disguise the true source and ownership of illicit funds. Bureaus de change and money services businesses risk environment. Bureaus de change and money services businesses, MSBs, provide essential financial services, including currency exchange, remittances, money transfers, prepaid products, and payment services. However, their accessibility, speed, and international reach make them attractive to money launderers and terrorist financiers. Criminals frequently use these institutions to move funds across borders, convert illicit proceeds into different currencies, and obscure transaction trails. Terrorist financiers may exploit MSBs because relatively small amounts of money can be transferred quickly to support operational activities. Consequently, regulators require these businesses to implement robust AML/CFT programs incorporating customer due diligence, transaction monitoring, sanction screening, and suspicious activity reporting. Bureaus de change and MSB red flags. Red flags associated with bureaus de change and MSBs include structured transactions designed to avoid reporting thresholds, frequent currency exchanges without an apparent business purpose, and transfers inconsistent with a customer's profile or known activities. Other warning indicators include multiple transactions conducted by related individuals, repeated transfers to high-risk jurisdictions, use of numerous senders or recipients, and transactions involving large volumes of cash. Customers may also exhibit reluctance to provide identification information or explanations regarding transaction purposes. Rapid movement of funds through multiple locations, branches, or intermediaries can indicate layering activity designed to conceal criminal proceeds or support terrorist financing operations. Lawyers, notaries, accountants, and auditors as gatekeepers. Lawyers, notaries, accountants, and auditors perform critical roles within financial and legal systems, making them attractive targets for exploitation by money launderers and terrorist financiers. These professionals may assist in establishing companies, creating trusts, managing client accounts, conducting property transactions, and structuring business arrangements. While these services are legitimate, criminals often seek to misuse professional expertise and credibility to conceal ownership, move funds, or create complex structures that hinder investigations. The CAMS framework recognizes these professions as important gatekeepers whose vigilance, customer due diligence efforts, and understanding of financial crime risks contribute significantly to the effectiveness of AML/CFT programs. Professional services red flags. Red flags involving lawyers, notaries, accountants, and auditors include clients seeking unusually complex structures with no clear commercial rationale, reluctance to disclose beneficial ownership information, and requests for unnecessary confidentiality arrangements. Additional warning signs include frequent use of client accounts to move funds unrelated to legal or professional services, transactions involving offshore jurisdictions, rapid movement of funds through multiple entities, and clients displaying unusual concern about regulatory reporting requirements. Professionals should also be alert to unexplained wealth, inconsistent documentation, nominee arrangements, and transactions that appear designed primarily to obscure ownership or conceal the source and destination of funds. Human trafficking and financial crime risk. Human trafficking is one of the most profitable forms of organized crime and frequently generates substantial illicit proceeds that must be laundered through the financial system. Traffickers exploit victims through forced labor, sexual exploitation, domestic servitude, and other forms of coercion. Because human trafficking operations require recruitment, transportation, housing, and payment mechanisms, they often leave identifiable financial footprints. Financial institutions play a critical role in detecting trafficking-related activity through transaction monitoring and suspicious activity reporting. Understanding the financial indicators associated with trafficking allows AML professionals to support law enforcement efforts while helping protect vulnerable individuals from ongoing exploitation and abuse. Human trafficking red flags. Common human trafficking red flags include multiple individuals sharing the same address, phone number, or financial account without a legitimate relationship. Other indicators include frequent cash deposits followed by rapid withdrawals, repeated payments to hotels, transportation services, online advertising platforms, or recruitment agencies, and payroll activity inconsistent with stated business operations. Victims may lack control over their finances, while account activity may be directed by a third party. Transactions involving escort services, labor-intensive industries, or high-risk geographic locations can also be concerning.